It's happening right now in very competitive markets in the United States. That's incredible. You don't have a ton of other opportunities to invest where there's a fragmented market, where there's still mom and pop owners, even at the $5, $10, $20 million purchase price range. It's out of control. And even though I've been in this business for 15 years, I mean, I'm still an evangelist for it. Like I've seen the good, the bad, and the ugly, and I know what this business is really like. And I'm still all in. I'm willing to bet my career on that.
All right, guys, welcome to another episode of The Report. Today, I got a special guest. I got someone who has inspired me and really helped shape and mold my growth as a real estate investor early on when I first got into real estate investing and transitioning out of the full-time W-2 gig as a full-time air traffic controller. I read his book early on in 2019, Raising Capital for Real Estate, and it honestly has changed my life in so many ways. But I would say the one thing before I bring in this guest is the one thing I realized is the number one skill that you can learn in today's era is how to raise and multiply capital. It is the highest value skill in America, how to raise and multiply capital. I got my man, Hunter Thompson. Hunter, welcome to the show, brother.
Let's go, man. I'm super excited about this. And it's been awesome to watch you put together what you've been doing and just rocket ship material. I love it. I know how this story goes. And I'm excited to watch. I'm excited for this interview as well.
Dude, we're just getting warmed up in here, man. I appreciate you coming out and always been a big fan. But hey, number one question I got for you, first question is, what is the biggest mistake that you see folks get out there? They get in the real estate game. They're like, hey, it's a light bulb moment because you don't know, and I didn't know this early on, most of these big commercial real estate buildings out there are owned by multiple investors. And you typically, it's a general partner or a principal that goes out and pulls together funds from various investors to take down these deals. Is typically not one individual investor. And so for me, that was a light bulb moment. I think a lot of people don't really realize that. But once they do, they're like, oh, I can do this as well. And so you see a lot of people jumping in the game and going out there and trying to raise private capital for deals. What is the number one reason that you see people fail to raise private capital when getting into real estate deals?
So I'm definitely down to talk about tactics and strategy. I want to do that, right? And like I wrote books about that. You know that. That book is super dense. And it's like basically an operating manual for how to raise money. But like, the honest answer to that question is way deeper than tactics and strategies. Like if I sit here and talk about podcasts and ebooks and content creation, which we're going to talk about, and leave out the reality, which is that most people are frightened. Most people are scared. Most people don't think they're worthy. Most people don't think they belong in the room. Most people aren't willing to fail and fall on their face. And even when I'm saying this right now, there's people that are listening to this thinking, no, I'm capable of failing. I've been through failures. And it's like, yeah, except for the fact that if you're watching this right now, you already know the playbook. You already know it, right? If I could sit here and say, go write an ebook, but if you're never going to do it because you're scared that someone's going to think it sucks, what's the point of listening to this, right? So I don't want to start with that. I want to start with this. If you're listening to this show right now, it's because you deserve it. And it is demanded of you because you totally can do it. The information is so clear. I mean, guys like you, guys like me, like we're doing everything we can to put this content out there, and we're nothing special, right? I'll put it a different way. We are something special. You are very special. So am I. But whoever's listening to this right now, you are too, in your own way. You're not going to be a good version of Rich. You're not going to be a good version of me, but you can monopolize yourself and your own voice. And the moment you understand that, then all of a sudden you've got no competitors and you can go to the moon. So let me just start out by saying that. Is that fair? I'm sure you agree.
Oh, it's 100% fair. And I think what you're really saying is being authentic and being true to yourself. And I think authenticity in today's age, especially in 2024 with social media and podcasts, all this content out there, there's a lot of people that are blowing smoke. But if you can be authentic, the more authentic I am, the more people trust me. And people like to do business with those they know, like, and trust.
100%. So going back to your question, when it comes to the world of real estate or private equity, and I've helped people raise money for all different things, startups, buying existing businesses, mobile home parks, self-storage, non-performing notes, performing notes, you name it. Basically, if it has to do with private equity, I've usually been a part of it in some way. And, you're so right. Like most people see like big high-rise apartments, for example, and today it's become popularized. But let's go back 10 years ago. I just assumed that I guess I thought banks owned all the you know what I mean?
Yes.
Like, it's like, who owns apartments? Like maybe like a couple of rich people. And then you come to find out that even if that is the case, that is a couple of rich people, the structure is actually totally applicable to people that are not so rich, right? a bunch of people got together and bought something or developed something. And that structure has been around for a long time. And it's really popularized in the United States for a lot of reasons, entrepreneurship being so so popular, and also the concept of capital and investing is a big part of American culture. And so this idea that there's this concept that together, rather than buying one single family home for $100,000 with $30K or $50K down, 10 of us or 100 of us can put in $50K into a deal, and now we can buy a $50 million piece of property that has a lot of tenants. So you get tenant diversification. It's $50 million property, so you can get lenders that are lending you tens of millions of dollars. So you're dealing with really big institutions, and therefore you get better terms. Yes, that's correct. You borrow $40 million, you get better terms
yep.
if you borrow $40,000. And so you're starting to play a game that before, 2010 or so, it was really left for ultra wealthy people. And then people started to uncover this. And now you can, especially if you're an accredited investor, you can put $50,000 or $100,000 into a quality piece of real estate or non-real estate. And so that's the structure that I kind of came to learn about because of mentors that I had at really good timing starting back in 2010 or so. And that's what got me to where I am today, following one foot in front of the other.
Yeah, it's definitely a limiting belief, I think, for a lot of folks that are out there, myself included. I never realized that you can go out there and raise private capital and take down these larger deals, and you hit the nail on the hammer, hit the nail on the hammer with what you said. You get access to better quality loan products, cheaper cost of capital by doing bigger deals with more dollar signs, more commas, and that sort of thing. So it's interesting. And, to be honest with you, I love these bigger deals. I like the smaller deals as well. I always encourage people like, hey, you should take the money that you're making with the bigger deals with investors and partners and then be buying some of your own individual stuff where you don't have investors to where you never have to sell these assets. Because I think ultimately that's how you really build wealth. But, at the end of the day, I think one of the best wealth building tools out there is the ability to go out there and raise and multiply capital and use that to go and improve and buy value add commercial real estate. This stuff is backed by commercial real estate. Commercial real estate rarely goes to zero, unlike the stock market. If you look at the S&P 500, I think since its inception back in the 1950s, 80% of those original companies in the S&P 500 are no longer in business anymore. But if you look at real estate, I don't care what asset class it is. It could be office, it could be retail, it could be some of these asset classes that are not hot right now. This building that we're standing in right now, recording this podcast, Hunter, for example, is 130 years old. You can see the original brick, you can see the original arches, and this building was built 130 years ago to manufacture goods. It was used as an industrial building. There's a train tracks right here, and they would load up the ships down here just to the west, and they would ship off goods and export them. Okay, 130 years later, this building is still bringing in income and cash flow via office space. And so that's why I love real estate. It's evergreen. It's going to be around for a long time. And that's why I'm like, man, if you're raising money to buy value add real estate, it is probably one of the safest investment vehicles out there from a long-term perspective.
100%. You add in the fact that it produces outsized cash flow. It produces depreciation, which is a tax write-off that doesn't have you come out of pocket to actually take the loss. You got this concept of forced appreciation as well as market appreciation, and this whole passive concept. Now, it doesn't mean that every real estate piece of deal you do does well. It's like saying, well, hey, they're not making any more land, so every real estate transaction. No, you have to actually pay attention. But it is one of the very few verticals of wealth creation that is very predictable, but not totally overbought. Meaning that bonds are very predictable, but of course they don't really create wealth. The predictability of outcome is very high, but real estate, it's still not fully institutionalized. It's still a very fragmented market. We're literally about to go under an LOI right now. I'm not going to say any details about it because we haven't got it yet, but the seller, it's a $15 million property or $20 million property, somewhere in that range. And the seller doesn't really have a rent roll. And it's they own one property. Okay. Now, this is a massive green light. You would expect any $20 million property owner, you would think intuitively, there's no way this person doesn't know what they're doing. There's no way they haven't raised rents in 2 years. Well, guess what? It's happening right now in very competitive markets in the United States. That's incredible. You don't have a ton of other opportunities to invest where there's a fragmented market, where there's still mom and pop owners, even at the $5, $10, $20 million purchase price range. it's out of control. And even though I've been in this business for 15 years, I mean, I'm still an evangelist for it. Like I've seen the good, the bad, and the ugly, and I know what this business is really like. And I'm still all in. I'm willing to bet my career on that.
Yeah, and here's the other thing. It's like, unlike a lot of these companies, especially tech companies where technology is just evolving continually. It's evolving at a quicker and a quicker rate. We got AI, we got social media, we got all this tech that's constantly changing the landscape. And that's why you see a lot of companies like Kodak and BlackBerry that boom and then they bust, the Blockbusters of the world, right? But unlike those companies, real estate is evergreen, right? There's never going to be a replacement for two things: a place for people to sleep and a place for people to store their belongings. So you start talking about multifamily, you start talking about boutique hotels, you start talking about industrial buildings. It's very evergreen, and those types of products will last very, very long. Now, the flip side of this, yes, it's a very safe investment vehicle long term. However, you got to have wherewithal as an operator, and you got to have the ability to go out there and execute on your business plan, because at the end of the day, if you are raising private capital to buy real estate, you are now custodian of someone else's money. And I don't know about you, but I want to sleep good at night knowing that I'm being a good custodian of someone else's money. And so talk a little bit about the importance of maybe getting the baseline knowledge and getting the wherewithal to operate, or maybe partnering with operators that know what they're doing and have experience before jumping in and just raising money.
For sure. But I think we got to put it in context, right? So like, what are we comparing it to? And so how I got into this space was what happened in 2008, right? I was just a college kid at the time, but I was obsessed with Jim Cramer and CNBC, and I saw this massive correction happen.
Cramer.
Dude, I was just like this. I thought those people were gods. I thought they understood everything. And so that's what most college kids think. You just pick an angle, whatever. And so I was watching CNBC like every day, and this started to happen, and this correction started to happen. And so that's got my attention. I was like, listen, I've heard billionaires talk about going all in when blood is in the streets. Blood is in the streets. This is a clear sign that I should go this direction. And so I started reading books, and I started getting into Warren Buffett and Charlie Munger, and started to invest, first my money, and then like moving my mom's money around, like just being like very strategic around investing in companies like Apple that had solid balance sheets, but had been hammered by markets, right? And I started to have a little bit of success in the sense that stock market started to rebound. What do you think? It's 2008. Obviously, you start to have that success. But something happened in 2010 that permanently changed my career, which was that in Europe, they went through a massive debt crisis, very similar to what the US had just gone through. And all of a sudden, after I had been obsessing about these icons in the finance industry and also the CNBC people, all of a sudden in 2010, there was massive volatility in the US markets because of what was going on in Greece and Italy and the bond markets in these countries. And so all of a sudden, all my research about Apple and Windows and like what the next tech startup was going to be, even if it was correct, was irrelevant. And all anyone cared about was the Greece bond yields. And whether or not the Greece bond yields stayed above 7% or below 7% became the number one determining factor of US wealth. So I'm watching my money that I invested. I'm watching my mom's money that I helped her invest in. Every day they'd be like, well, the Greece bond yields are below 7%, so it's okay. And then it would go above 7% and it would crunch. And I was like, what is going on? There's no way I myself could have read enough or done enough due diligence or research to predict that the Greece bond yields were going to play a role like this in our wealth. And so I've got to get out of this casino. I've got to get into
the Wall Street casino.
100%. I've got to get into something that's predictable and has cash flow and isn't going to randomly wake up and go, hey, you're never going to believe this, but there's a hurricane in Italy, so you're screwed. It's like, what? How could I possibly predict that? And so I wasn't even going all in on real estate. I just wanted to get away from what I refer to as the stock market casino, an industry where the entire thing is predicated on zero incentive alignment with the person that sold you into the investment. So I went looking out and I quickly found real estate. And in particular, I was drawn to what we talked about earlier, syndicated real estate. So I skipped a lot of the fix and flip stuff because I wanted to work with people that were making or losing millions of dollars. And that's kind of what my background was. That's why I got into the space. So when you say this, it's like, compared to what? Are there problems in real estate, and can real estate deals go wrong? Yes. And can operators underdeliver? But compared to what? Compared to a stockbroker that literally takes a 2% clip every single year, regardless of performance? So their incentives are not to try to pick good stocks, which is basically impossible, but to just raise more money, get more money in the door. And as we all know, and Tony Robbins did a good job of releasing this information, but basically no mutual fund, no stockbroker net of fees can keep up with the market. So that industry is over, and yet the marketing machine is so powerful, people are still doing it. So you can literally just go and invest in the market directly. Go buy the S&P 500, fire your stockbroker, fire your financial advisor. Not financial advice, but guess what? That's what I would do because it's a useless game. And so once you uncover that, then you're starting to get in this world of if it's totally done by someone else, like 100% done by someone else.
And real quick, Hunter.
Yeah.
I want to just add one more point to the previous conversation. What you just said is, for someone out there, if you're investing in the stock market and you're looking at real estate syndication to invest passively, stock market, you could argue is relatively passive. You just buy some shares and you see what happens. Now, if something goes wrong or you have a question about how that company is operating, you typically can't just pick up the phone and talk to the CEO. But with a lot of these private real estate syndication, these offerings, you have the ability as a limited partner to get on a call with the CEO, with the principal, with the lead GP, and actually get an update of what's going on, which is pretty cool. You cannot do that in the stock market. So that's one other point I wanted to add in there.
Yeah, and the information they have is actually relevant. So like, let's say you could talk to Tim Cook and be like, what's going to happen next quarter with iPads in China? It's a really complicated question, and there's a group of Ivy Leaguers that can't figure it out because it's not a knowable fact. There's too many unknowns associated with the question. But if I have a senior living community or a self-storage community in Florida, it's like, well, what's going to happen next quarter is there's way more demand than there is supply. And so rents are going to go up, and basically it's going to be just exactly the same. It's a slow and steady approach. There's so few variables. Maybe there's a storm. Maybe there's a hurricane. Maybe there's like a natural disaster. But outside of that, it's very slow and steady wins the race. And so because of that, the risks are way more understandable and knowable. And therefore, a small family office or an individual person, you can actually invest and have a market advantage.
And I gotta be honest with you, man. I'm actually shocked with like getting in the real estate game, commercial real estate. I'm really shocked by really how low the bar is. And what I mean by that is I think there's a lot of just mom and pop. We talked about at the top of the show. There's a lot of mom and pop operators, especially like in the boutique hotel space, where they're not utilizing any technology. Often some of these boutique hotels is the only piece of real estate that these folks have ever owned in their entire career. And the way they're operating it, it's just so underperforming because they don't know what they're doing. So I think the level of sophistication, the bar is very low. And some of those operators can still win. That's the crazy thing is like, you can be a shitty operator. And if you own the asset for long enough, 10, 15, 20 years, you're still going to come out on top. And that's why I say real estate is a very forgiving game. Every deal we get into, there's problems that we can't account for. Like we had one of our hotels get flooded out in January, right? But like we pivoted, we grinded, we figured it out. And our investors still got paid, lenders still got paid, everyone still got paid, and that deal will still do really, really well once it's all said and done. And so what I'm saying is that actually, if you can actually give a fuck and actually put a little bit of effort and put a little bit of like, have a little bit of wherewithal with your idea, your business plan, and how you execute on that business plan, how you market, how you design these properties, you can actually do very, very well because the bar is actually relatively low.
Yeah. And I think that it's important to know why that is.
Why is that?
So when I got into this space, anyone listening to this right now, if you're in your first couple of years, you're still figuring out how this opportunity exists. And sometimes it can make you feel like, is this all some kind of scam? Like, certainly there's no way that I'm uncovering this, right? Because it feels very self-directed. If you found out about Rich Dad, Poor Dad, not because your teacher made you read it, but because you were interested in it and you went on this crazy rabbit hole and now you're all the way through the Bigger Pockets thing and now you're listening to Rich's show, you're going on this journey. You're uncovering this stuff yourself. And so you look at it and you go, there's no way that I just kind of like figured this out. There's no way, it's too good to be true. Well, let me help you, okay? It's because the dollar sizes aren't large enough to attract institutions. So you're able to play this game at a level that you're just not able to play in the open markets, in publicly traded markets, or even institutional sized deals in real estate. Because any savvy, sophisticated operator that's goal is to do bigger and bigger deals, they eventually go and trade bonds, they get into the public markets, and they do very large $100 million plus real estate deals. And so you've got this massive discrepancy, everything from a $50,000 single family house to a $50 million piece of real estate is really fragmented. And there's so much like mom and pop owners or single property owners that haven't developed systems and processes. And you're totally right. Sometimes you can find them and be like, and they're still winning.
Right.
And they don't have Calendly, for goodness sake. You know, they're not using like standard technologies that are $15 a month that would save them immensely. So that's the answer.
Yeah. I know older real estate investors that have been in the game for 30, 40, 50 years, and they're like dicks. They're like not good human beings. The way they talk to vendors, the way they talk to brokers, everyone hates doing business with them. The property managers hate them. And they don't utilize any technology. They don't even know what cost segregation studies are. And guess what? They've made fortunes. And that tells you how low the fucking bar is and how forgiving this investment vehicle really is.
Totally, man.
Yeah.
Totally.
So anyways, yeah, I mean, there's definitely deals that can go bad. I know operators out there right now that have deals that are going bad. Investors haven't been getting paid. And so, yes, it's very forgiving, but at the same token, you should have the wherewithal before you really jump in and just fucking rip it. You talked about partnering with other operators. That's a good way to do it. If you have the ability to raise money, but maybe you don't have the experience with a specific asset class, well, you can partner with folks that have the experience operating, and then you can bring the capital portion. Talk a little bit about that.
So that's a lot of my background.
Yep.
So when I got into the space, I quickly found myself being much more inclined to find really quality operators than try to compete with them. And so I wanted to say, hey, listen, I don't ever want to do my first deal. How could I possibly do my first $100 million deal? But maybe I can find someone that's done $100 million worth of real estate and partner with them. And so that was my kind of calling card. And so I went out to the marketplace to try to figure out what would that look like? How could I partner with a group? If they have done $100 million, like what's the X factor that would get me a meeting with them? And so I quickly found out it wasn't finding good deals, finding good markets, knowing what a cap rate was, or anything like that. They already had all that figured out. But the thing that they all needed was money. And from my perspective, just a little bit. $500,000 gets you a meeting with a lot of non-institutional players, including myself, right? And so if I would go to them and say, hey, listen, I like you guys, I want to invest with you, and my goal is that eventually I'll be able to partner with you by bringing capital to the table. And so I would build relationships like this, investing 25, 50 grand, and start to like get to know them, conduct due diligence, fly around the country looking at deals and start to build a real relationship with them. And once I did, I implemented this concept, which is now called fund to funds. It was always called fund to funds, but I didn't know that was what it was called. Basically, just to pool an investor together or in an LLC to invest in their deal. So I would create an LLC, try to get 10 friends and family members to invest in this LLC, and all that LLC would do would invest in their deal. And from their perspective, they're like, well, dang, if you're going to just show up on our doorstep with $500,000 of LP capital, meaning no control rights, no voting rights, not if they underperform, I get the property or something crazy like that. They're like, we'll give you slightly better waterfall structure, better economics to your LLC. And so then what I would do is that at the LLC level, I would just go tell the people, I'm going to take basically the delta that they gave me as an extra split at the LLC level, like a 90-10 split at my LLC level, so that they're basically getting the same deal economically as if they had gone directly,
Right.
but I get to make 10% because I negotiate an extra 10% from the operator. Does that make sense?
It does make sense.
Okay.
Yeah.
So that's how I decided to do my first deal. You've read my book, so you know.
Yeah.
I went to an operator that I had a ton of respect for and was like, I'm super confident I could come up with $500,000. That's 10 people investing 50 grand. And I thought I could probably come up with 2 million. And I had a luncheon with like some very wealthy people, 30 accredited investors, gave the pitch of a lifetime in incredible market timing, 2011 or so, and had already created the LLC, by the way. At the end of the luncheon, I was like, hey, just write down on this piece of paper what you're interested in investing and fold it so it's private, hand it back to me. And nobody wrote anything. And I was $500,000 short on my $500,000 raise.
Did you open those papers in front of everyone, or did you wait till everyone left?
Oh, no. I literally, before I did this, by the way, I texted this girl, Chrissy, who I was trying to impress. being like, I'm going to my first capital raise. I don't know if it's going to be 1 or 2 million, but like, I can't wait to share it with you.
Yo.
I go back to the room, it's private, and I like unroll everything. And I'm like, dude, no one wrote anything. Like, no one wrote, I'm interested, and email me later. No one wrote like, contact me after the fact. No one wrote anything at all. And I had to text her and be like, well, I came up a little short. Thankfully, I ended up figuring out, now we're married, we have a baby. But the point is, I bombed my first capital raise. And I was like very fortunate. Like, I'm from a family where I knew wealthy people in Memphis, right? And so like, I feel very blessed for that. But the point is, even with that as an advantage, I still bombed on a great deal.
Now, looking back with you've raised over $100 million now in your career, and you've really mastered it. Looking back now, when you dissect that first capital raise, what went wrong?
I mean, I uncovered this amazing deal and fell in love with the deal. And so I presented to all these people that had never invested in real estate before, certainly didn't see me as an expert, certainly weren't nurtured or excited or enthusiastic about investing in real estate for the first time, let alone the mobile home park business. And so I'm coming in as this evangelist for something they're totally uninterested in and being like, this is a great deal. I'll put it in perspective. Let's say that I had this dairy farm that was clearly like a 70% discount to market. And I show up on this podcast, I'm like, Rich, bro, I got this screaming dairy farm. 70%. Look, the comp next door sold for 10. We're getting it for 3 million. You're going to be like, I don't have time for this. Leave right now.
Right.
And that's basically what they did. It's like, I have no clue what you're talking about. Like, you don't have time to deal with the dairy farm, right? So that was the big mistake. I fell in love with this deal as opposed to, attracting people that were actually interested in what I was talking about and not relying on the pitch of a lifetime and the deal of a lifetime.
Yeah, that makes sense. I think a lot of people say, I hear this thrown out there all the time. If you find the deal, the money will come. But yes, to a certain degree. But like, if the operator is, let's say, your uncle, and your uncle is a drug dealer and a heroin addict that's living on the street, are you going to invest in that deal? No, right? And so I think you need the wherewithal first before you can attract the capital. What are your thoughts on that?
I mean, look, I don't think people are like, this kid's a meth addict. But listen, I've done a bunch of crazy stuff in my life. You know what I'm saying? So like, maybe like,
no, I'm not saying in that example. I'm saying like just a
no,
hypothetical example.
I'm just teasing. But the point is, look, those were friends and family members. One of them, probably the last time they saw me, I was drinking in Christmas. You know what I'm saying? So like, your point is actually well received. There's truth to that. It's actually way harder to get people to go from seeing you in one light, whether it's you drank on Christmas or it's you're just like a young kid. Even if you're not that young kid anymore, it's hard to get someone to change the light in which they know you. Like, I'm sure you can think of people that you've tried to get to invest in your deals and they just don't have the ability to change their perspective. And it's not on you. It's probably more on them, but that's okay. I don't have time for that. What I want to do, rather than smack my head against the wall trying to convince this random person or a family member to invest with me, I want to attract someone that's way further on the customer journey that's about to make that decision anyway. And I can just lead them to a much better path than going with a competitor of mine. And so I create content that is about that. And I speak to people that are already thinking about investing in real estate. And then the customer journey is way easier, And so for context, I have a coaching business. I own a company called raisingcapital.com. One of the reasons I teach raising money is it's like they're already well on their way of their customer journey. If I were teaching how to flip your first house, it's like, I'm going to get people that are like, never started a business before, never done something as an entrepreneur before. But like, I want to get people right before they make that buying decision. It just makes it a lot easier. It makes the business much more scalable, by the way.
That makes a lot of sense. So to recap, what you're saying is this: if you're raising capital and you got two investor avatars, and investor A is friends and family member that has never thought about investing into a real estate offering ever, but has a little bit of money and you've known them for 20 years. And investor avatar B is someone that you don't really know, but has money and they've been looking at real estate offerings. They are ready to pull the trigger. They are ready to invest. They are warmed up and they are just now meeting you for the first time. However, they are warmed up to investing. They're committed to investing into a syndication, whether it's you or 3 other operators. You would rather be working with B versus A because A has not even thought about even fathomed. It hasn't crossed their mind about investing in a real estate offering.
Totally.
Okay.
And I know that as an entrepreneur, when you're getting started, you are on the do whatever it takes mentality, as you should, which means you're going to have to hit up friends and family. You're going to have to go through those awkward conversations. You're going to have to realize what happens when people say no to investing with you. So I'm not saying don't do that. I'm just saying don't use it as a sign that you're not good enough or a sign that that's what's going to get you to the next level. Because imagine you go out to your uncle, the first conversation, your uncle's like, yeah, sure, I love you, Hunter. Here's 50 grand. You're like, damn, I got another uncle. This is going to be easy. It's a misleading signal of success. On the other side, let's say you go to your aunt and your aunt's like, no way, I don't ever do business with family. You're like, oh shit, I'm not going to be successful because I've known her for 35 years and she won't even invest with me. It's like, that's unrelated. What you should do, the only way to scale is you have to build a system capable of attracting people that have never heard of you and convert them into 6-figure or 7-figure check writers. And by the way, whoever can do that shortest time period fastest wins, because that's how you actually scale. So like, that's why I talk about the customer journey thing, because if it's going to take me from being like, hey, are you a random CPA that hates your job, and starting there to get them to go all around, you read Rich Dad, Poor Dad, then start listening to Bigger Pockets, then come on his show and listen to my, like I want to get them when they're like, should I invest in blank or blank? Something like that.
Yeah. And so a lot of those folks are going to be accredited investors, right? And I know with the first couple of deals, I know most of my first 2 raises, I would say the majority of the folks were friends and family. And I didn't have the track record to go out there and quote unquote attract accredited investors at that point. Now, more than 80% of the money we bring in is accredited investors that, I mean, look, I'll be honest right now, my first couple raises, I would spend 8 to 10 phone calls and 8 to 10 meetings with an investor to raise $100,000. And now we have investors wiring in $250K chunks to our fund. And I don't even have conversations with these folks, right? But that's kind of how the game works. And that's like the evolution of the game. But I had to go out there and build it and grind and hustle and do all this content and like make all the mistakes and go out there and build my resume and that sort of thing and establish my reputation. And then now it's becoming easier and easier and easier. However, in the beginning, it was not easy. So my question is, with those first couple deals, for me, it was hard to attract accredited investors. What methods can someone listening to this do to attract accredited investors in their first couple raises?
I mean, it's hard, right? Because like I've helped a lot of people raise their first $1 million. And so a lot of that is going to rely on things that are outside of my control, right? They're coming in where it's like, hey, Hunter, I have a background as someone that's super into the faith world, and like all of my network is super like low income people that I used to help out, like in the world of nonprofits. Like that's going to be a really difficult place to start. You can still do it. And the fact that someone came in and like made it work within the time period is just insane. We've had plenty of people do that, but it's like what they're starting from is similar to like going out into the woods and like you got the flint, and I don't even know how to make fire, but you get what I'm saying? Like you're smacking rocks together. If you just keep grinding, you will do it. The other side of the spectrum is someone that's like, I just sold my company for like $80 million. And now I'm with my other friends that we've all sold our company. We're in this mastermind together. I've never raised any money, but like I've got a good start. It's like, that's a very different conversation.
Yeah,
so
yeah, totally.
You just got to say, this is the crazy part though, is that no matter where you start, like even if your family is a billionaire, right? And even if you start there, eventually you run out of money. Eventually you run out of leads. How do I know that? Because billionaires raise money all the time, right? Because there's way more deals than there is capital from their perspective. And so the good news is in about 3 months, you're probably going to tap out your natural network, even if it's $500,000 or 500 million. Like you're going to eventually get there. And then you've got to develop what I talked about. Yeah. So the good news is it doesn't really matter that much, but it's going to take work. And so the faster you realize that, and the faster when you realize what it means to work hard, the better. And that's the beauty of entrepreneurship.
Hey guys, real quick, the only way this show grows, the only way we continue to bring on bigger and better guests is if you guys rate, review, and share the show. So if you could take 2 seconds or the click of the thumb to review on Apple or Spotify, it will mean the world to me. But more importantly, we'll be able to reach more entrepreneurs and more real estate investors and help them build wealth through this podcast. Now back to the show. Yeah, dude, I always say like in order to build a sizable real estate portfolio, you need 2 things. You need deal development, so access to deal flow, good deals. And then you need capital development, access to money. And that's going to be both debt and then investor equity, or maybe it's your own equity. And if you have those two things, everything else within these projects can be delegated out. The asset management, the property management, the renovation management, all these other things that need to go on behind the scenes, the admin work, the investor reporting, all that can be delegated out. But the deal development and the capital development are like the main two things. And so if you have access to both of those, there's no limit or ceiling in terms of like how big of a real estate portfolio you can build. The sky is the limit.
Totally.
Right. And so I think for anyone listening to this right now, if you're like, hey, I want to become a full-time real estate investor, I want to build a big thing. It's like, okay, well, solve those two bottlenecks and make those two rocks something that either A, you figure out how to bring to the table, or you partner with someone else that can bring those two things to the table. And that's the secret sauce. And that's how you really grow a big thing.
Absolutely. And, especially in the world of raising capital, like it's going to be very difficult for someone to partner with me on a deal. But it's just a matter of, dude, if you can show up with $500,000, that may not make you a partner. But dude, what if it was 50 million? Then obviously me and my partner, Tyler, are going to be like, this guy wants to partner with us. He wants to bring 50 million. We're going to have that conversation 100% of the time. So it's just a matter of how big the check is and what the terms come with, but it will get you in every single room is raising capital.
Yeah. And you mentioned for someone new out there, it's like, hey, okay, like I want to start establishing myself as a thought leader in the space in order to attract private capital. You got to start with putting in the work. You got to get the reps in. You got to put in the at-bats. And a lot of that is you talk about in your book, which I utilize a lot of those methods. Scaling your email list. One of the things that I took away from you that always resonated with me was first impressions, everything. So, go spend the extra $500, $600 to go put together a really nice, elaborate pitch deck. Go hire a videographer or photographer to go take nice professional shots of the asset that you're buying and put together a nice, well-branded pitch deck. Go start, go have a company name. It's like, hey, have a company website, a company name. Don't be using an @Gmail email or @yahoo.com. It should all be at your company email. It should all be legit because first impressions, everything. It's not just talking to investors, but it's reaching out to brokers, reaching out to lenders. Like first impression is literally everything. And so that's one of the biggest takeaways I got from you. And that's first and foremost. And then after that, it's like, okay, well, how do you build these lead magnets in order to start attracting private capital and that sort of thing? And one of the things you talk about is having an ebook.
Yeah.
Talk a little bit about the benefits of having an ebook.
Well, first I gotta say like what you just said. I'm glad to hear it resonated with you. And obviously you've taken that to the next level, right? Because this investment in this, and I see that from afar and others see that. And it's like, okay, you make that assumption, like he's making a big bet on himself to have that first impression come off in the right way. I like that. It's a massive green light. And then what happens? Well, you can start attracting great people to your platform. And then now other people see you having conversation with people you respect. And I see that and other people see it. It's like, all that starts to grow. And so before any investor talks to you, they're pretty much pushed in through that indoctrination system that you've created that's all about first impressions and following it up with real background. And so for me, if you're listening to this and you want to do deals, think about it. If I go and talk to a broker and the broker only cares about one thing, is the deal going to close? That's how they get paid. They don't care if I know how to operate. None of that matters to them. It's, are they going to buy the deal? And the way they buy the deal is if they show up with the money. So if I'm going in and we're putting in an offer and I have a competitor over here, we have the same number, but I own raisingcapital.com, which means I'm going to show up with the money. Who do you think they're going to go with, right? It's just, and how much was that URL? Like, think about it in your head. What would be a number that would be reasonable? I'm not even going to say the number, but like, think about it. Okay. Now imagine that we go into the same deal and I offer $100,000 less, but I still own raisingcapital.com. Would that make up for the number in your mind? Probably, but that would be one deal. Right. So
I wouldn't even say that. I would almost I think a lot of sellers out there in the marketplace and brokers that are representing these sellers, if their number one priority is certainty that the deal is going to get to the finish line and everyone's going to get paid out, I think that a lot of sellers will go with a little bit less strong of an offer with a buyer that has 100% certainty to get this deal to the finish line.
Everyone knows that that's the truth. The last deal that we did, we offered $1 million less than the person that offered more than us. We got the deal because of certainty and close. Now, I'm not taking full credit for that. The person that we partnered with had done a deal with that exact broker before, but it's the same conversation. It's, I know these guys, they're going to get the deal closed.
Mm-hmm.
Now, go back to
by the way, real quick, with the domain, I'm just curious. We bought hotelinvesting.com and I was shocked. It was just sitting out there.
There you go.
And I was like, it was for sale by a broker, but I was like, the price tag on it was like not nearly as much as like we would have paid. And then, you know, we always negotiate everything, right? And so we negotiated that thing like 50% off and ended up scooping it. Even though I would have paid a lot more than what they were trying to sell it for, we got 50% off of what they were trying to sell it for. And so I was kind of shocked. So you said, what was the name of your website?
Raisingcapital.com.
And that was just sitting out there.
Yeah, I bought it directly from the owner.
Yeah.
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 And I promise you it was less than you're thinking. Like it's crazy. Now, but part
Great
of that,
investment. Great investment.
Totally. And so that doesn't mean you have to go and buy hotelinvestors.com or whatever, but I'm saying like go on to GoDaddy or go on to ClickFunnels and buy that URL that resonates with you from a business name perspective. Just go for it. It's $20. To me, I like have this like graphic design kind of inspiration thing where if I go into 99 Designs and I'm like, we're starting a new company, it's this. Once I see that logo, it's on. So like maybe that's the thing holding you back if you haven't yet done it. 99designs.com, put in the information. You'll have a logo turned around in 2 weeks. And then it's like, it's real. We got to go make this thing happen, which will help you, leverage that next time you go and talk to an investor because they're going to search for you. And I can't tell you, like, we're all just advanced apes. And so if I get an email from someone at Gmail, even if later they change it, I'll never forget it in my subconscious. So like that's a $20 fix. Going, getting the email address, going to GoDaddy.com, buying it, getting the logo, and now it's permanent. You reach out to me, you reach out to him, whatever. The subconscious is super powerful. And rather than me sit here and say, what do I care? It's only $20. Does it really mean he knows what's going on? I can't help but think that it does matter. And so don't fight that. Just go and do it.
Yeah.
Can I talk about ebooks? Because I know you asked a question about that.
Yeah,
just real quick.
Yeah. I want to learn about it because it's something I've thought about putting an ebook out. I've never done it.
Okay.
But I was thinking about putting a really good quality ebook that's free on hotelinvesting.com. And then we can drive a lot of traffic over that way to download the free ebook as kind of a lead magnet. But what are your thoughts there?
So so much has changed since I wrote that book. But the reality is having an opt-in, some sort of exchange of value for an email address and now a phone number for sure. That's certainly changed since I wrote the book. Get the phone number, by the way.
Texting is huge.
Totally. But people have gotten super over texted in their ebooks. So I try, and this is guidance that for you to use for sure, is the faster you can create time to value in your lead magnets, the better.
What do you mean when you say the faster you can create time to value?
For the audience, and not trying to overwhelm them with how smart you are, but trying to actually solve for what they're genuinely curious in, which is probably not all the details that you know about investing in hotels, but whether or not you know what you're talking about and whether you're credible. So like, let me give an example. If I were to ask you, hey, write a cool book about hotels, you could write 50,000 words like you know your stuff. That's how long my book is, right? But if I'm a new person, I don't trust you. You're not going to get the 20 hours it takes me to read a book or whatever, 10 hours. So you want to like front load their experience so that you get this pop as quickly as possible so that they go, Rich is my guy. Now I'm in. And if I want to learn about hotels, I'll definitely go to him. So you start with this tiny little domino, which is first name, last name, phone number, email address. And then the next domino is more about their time. How fast can you communicate that they're credible, that you're credible, and give them a pop on their experience, which is their time investment. So I'll give you an example.
Yeah, give me an example of that.
We used to write a ton of ebooks where I was just insecure about how much I had done. And so I try to like overwhelm them with how smart I am, but no one cares about that because no one knows who I am. So then we started doing things like, hey, here's your 10-point due diligence checklist. So they open it, they see 10 questions, but they're probably not asking like 6 of the 10. And they're like, oh, wow, that saved me. That's it. No time at all, just instant. If they open it, they're getting value. That would be what I would suggest to you. So it's like, we've seen a lot of things like Excel models or financial freedom calculators or due diligence checklists really get that time to value as short as possible so that if the email's opened, they get the value. And then you can go to another domino, which is slightly bigger. Maybe that's a 15-minute video of you going through the due diligence checklist, talking about things, nuances that they would not know about. And then you can slowly work your way up and up and up to a phone call or a deal.
I like that. So you're providing value to the limited partner And when you say due diligence checklist, you're not talking as the investor or active GP buying the deal and doing due diligence on the property. You're talking about a limited partner doing due diligence on the GP before they participate in the offering.
10 questions every
Yeah.
passive investor needs to know about investing in hotels.
Yeah. I
And
love that.
always remember that they are not you. And so they don't want to know about DSCR requirements. They don't want to even know about market dynamics. They want to know, do you know what you're talking about? And how quickly can you give them that confidence that they can send you $50,000? And I mean correctly, they should be educated, but from the view of a passive investor, not an
Yeah.
owner operator.
Yeah, I think a lot of I see this as a common mistake with a lot of like real estate investors out there that are like putting out social media content, or maybe they're starting their podcast for the first time. And by the way, shout out to your podcast, Cash Flow Connections. You were like another one that was instrumental to me early on. Like one of the things that I got right early on when I was green, I didn't know any real estate and I didn't know what the hell I was doing yet, is I learned this from you and Joe Fairless, is like, just fucking start a podcast. And this is my second podcast. A lot of folks listening to this probably don't realize it, but this is my second podcast. My first one was called The Multifamily Takeoff. It's now The Real Estate Takeoff. And my two old partners I had it with, I split up with them about 2 years ago. I said, you guys keep the podcast. I'm going to start my own. I took everything I liked and didn't like about that podcast. I made it into this one. But that's the one thing I got right, is day one, before I even owned any real estate, I said, I'm going to start a fucking podcast and I'm just going to start interviewing real estate investors that are much smarter than me. And it accomplished a couple of things. I mean, one, I get to ask them legitimate questions that I had. But two, I gained a lot of trust and built a lot of like social capital just because I was rubbing elbows and interviewing folks that were a lot smarter than me. And it helped me raise a lot of capital from that podcast. Even though that podcast never blew up into a big thing, I still raised a lot of capital from it. So I want to shout you out for that. That was one of the early on things that I did right.
Love that, man. And people may listen to this now and say, well, that was back then. And obviously everyone has a podcast now. Why do you think that is? Because the risk is tiny compared to the upside. Like the risk is that you buy a $120 Blue Yeti and reach out to someone you have respect for and try to ask them questions that you'd probably have to pay them $1,000 to ask them.
Yeah, I know.
That's the
Think about
worst
that.
case scenario. So like if I found out today that you were the only person that listened to my podcast, it's still a crazy win for me because I get economic guidance from former consultants of the IMF for free. You know, I get I've talked to people that have raised $600 million for free. So that's assuming no one ever listened to it. So
You
that's
still
like,
got the one-on-one mentorship.
obviously.
It's like crazy.
And you can hit up that same guy and be like, listen, do you do coaching? They're like, sure, it's $50K for 3 months. I'm like, okay, well, what about free for an hour? And they're like, well, how big's your podcast? I tell them, okay, I'm on. You know what I'm saying? And so maybe if you're just starting, maybe you don't get to ask that guy, but you can for sure ask someone else. And slowly you start to build that momentum, and quickly that guy's coming on, because that's exactly how I started, with no following and no one listening except for my mom.
And then
literally nothing.
Bro, and then in addition to that, it's like, then you spend an hour with this individual and you build a relationship. And next thing you know, it's like, okay, now you exchange phone numbers, and now you actually built a relationship, a true friendship with these folks that come on your podcast. And guess what? Like after a year, 2 years, 3 years of having a podcast and interviewing all these people, if you ever need something, a quick question, like I call my podcast guests all the time. Hey bro, quick question. I know this is like your expertise. Do you have a second? Yeah, of course. What do you got? Boom. I get to ask whatever question I have. And now I'm getting high level $50,000 advice because there was a value exchange. I brought them on the podcast. I gave them attention. I gave them more eyeballs and attention that they wouldn't have had. In exchange, we develop a relationship, and you never know what doors or opportunities that's going to open up for you down the road, which is very valuable. But what I was going to say is this. The biggest mistake that I see real estate investors make when they go start their podcast is, let's say they're looking to raise private capital. They're not thinking about, okay, who is the avatar? The avatar is, you want to attract limited partners. Okay, so if you're teaching how to go buy multifamily deals, how to go through the due diligence process, how to underwrite these deals, how to go do all this stuff, those limited partners, they're not wanting to do that. So the people that you're attracting in these podcasts are people that want to learn how to buy their apartments themselves, but you're not attracting the folks that actually have money. That's the number one mistake I see.
Totally. But this is because most people aren't good marketers and aren't thinking about things through the lens of marketing. And so good marketers know that it's not all about you, bro. You're not doing all of this for you. It's all about them. And there's a deeper message here. Like, there's a big like anti-capitalism move in America, and they think it's like people get rich by just being self-obsessed. And it's like, do you know what we talk about all day, every day at my company? How to get our clients better results faster. That's what any company is focused on if they want to get rich. That's how you get rich in America. Like barring, government intervention or some ridiculous capital cronyism stuff, the way you get rich is by adding value to other people. And so what most businesses do all day is they're like, oh gosh, this guy asked for a refund. We need to solve that problem so that never happens again. Duh. You know what I'm saying? So my point is, same with marketing. People come at it with this mindset of like, okay, what do I want to know? What are my pain points? What are my problems? And if you really want to create an audience of people that are obsessed with your content and view you in a positive light, it's like you got to hit them in the heart on where they are, especially in today's climate. To really get someone to pull over their car and take down your information, you got to speak to their soul. And so for me, like, if I were to go on my podcast and be like, doesn't it suck when you have like 4 directors that report to you and everyone wants to know about what we're going to do at this upcoming event that we're going to spend 7 figures on? Dude, who relates to that? Like me and like 20 other guys. But if I go on my podcast and say like, are you worried about the reality that the education system has crumbled and that it's up to us to kind of build out these new pathway for entrepreneurs? Is that a pain point in your life? Well, cool. I have a solution for you. This. Or, hey, are you a burnt out CPA that is looking to actually create passive cash flow? Here's a vehicle for you. It's called self-storage. That's totally making it about them and not dealing with my problems. Who cares about my problems and dealing with directors of marketing?
Yeah.
But yet that's the kind of thing that people do.
Yeah, absolutely. It's all about giving value, right? And I think whenever, I put out a piece of content, I always approach it as like, am I providing enough value to the audience to where if they see this post, they see this clip, is it good enough to where they're going to want to share it with their friends? They're going to want to share it to their story. If the answer is no, I need to go back to the drawing board. We need to come up with a different version. And if we still can't get it right, then we need to scrap it and put out a different piece of post. And that's just that's how the game works. You can teach it to an 8-year-old. It's really not that complicated. You got to give more value than you're taking, right? And that's the long game ultimately. So for someone listening to this, Hunter, and maybe they've already been investing in real estate and they're looking to go do their first capital raise. By the way, you were on our boutique hotel mastermind call 2 weeks ago, dropping a lot of value on how to raise private capital. My group is killing it. We got 60 members right now. We have officially 8 hotels under contract being bought right now. And so there's a lot of capital that's going to be raised here in the next 2 to 3 months in the mastermind. So question for you, if someone's listening to this right now and they're about to go do their first raise, what are like 2 or 3 things that they can implement today that are going to help them be successful with their first raise?
I'll give you some super simple ones that seem, after you know them, you're like, yeah, I could have done that. But the reality is I've helped a lot of people and most of them don't do this. The first one is, obviously, don't even rely on the deal. We already talked about that, so I'll give you that as a freebie. Next one is neediness kills deals more than anything.
What do you mean by that?
So before you talk to anyone about a deal, it's really important for you to realize that there is a bond market of negative interest rate bearing bonds that is $17 trillion, meaning that $17 trillion is slushing around the global economic sphere right now, searching for yield, and the best they can do is a negative return. So there's no shortage of money. There's a shortage of access to the kind of deals that you have access to. So you are in the position of power. You are the prize, as Oren Klaff said. And I would check that book out, Pitch Anything by Oren Klaff. He's the man. He wrote a little thing on my book, which I'm super excited about.
Pitch Anything, yep.
The other one is, because neediness kills deals, people need to understand that whatever they can do to increase their status by suggesting that time is of the essence, that your time is valuable, it will help you dramatically. So for example, if I'm going to get on a call with an investor, I'm going to take the lead of the call. I'm going to imply that I've done a call like this over and over again, even if it's my first time. And I'm going to set the agenda and the start time and the end time of the call all within about the first 15 seconds.
Give an example of that.
Hey, how's it going? This Hunter with ASIM Capital. Is this Bob?
Yep, this is Bob.
What's up, man? Hope you're doing well. Is now so good time for you?
It's a great time. What's up, man?
Amazing. So I've got us blocked from 2 to 2:30. And if it's cool with you, I'd like to jump right in. I'd like to start with just hearing a little bit more about your background, how you found out about us, and I can tell you about this deal and answer any questions you have. Sound good?
That sounds fair. Let's do it.
Boom. So I know that seems fine and you hear that sounds normal, but like most people won't start the call with that level of intensity and assuredness and just that script. And once you do that, you in this metaphor, are going to relax because you know it's not going to be some long drawn out pitch that's going to go on for how long. It just shows you, I've got to go because I have other investors just like you. And that actually gives you a lot of confidence. Now, if that's not true and you actually have all the time in the world, put someone on your calendar. Don't lie to your investors. Drop someone on there so you know you got to go. Even if it's to check your emails, just make sure you stick with it, because when you're getting started, it's really important that you get in the habit of having that sense of urgency and that your time is valuable.
Yeah, I love that. And to take it a step further, like I do this on investor webinar calls. I'll get all these investors on a call and I'll set the tone right at the top. I'll say, hey guys, first of all, I just want to thank everyone for taking the time out of your day to come out to our investor call. I really genuinely appreciate it. Expectation wise, we're going to stop this call at the top of the hour. I'm not going to run past an hour. We're going to have a hard stop out of respect to everyone's time. I'm going to start off by introducing the team. I'm going to get into the deal flow, why we like the deal, the business plan, and I'm going to open it up for Q&A. If you guys have questions, drop your question in the chat box. Here we go. Boom. I just set the tone. I let them know it's going to be no more than an hour. This is the flow. If you got questions, this is how you do it. And then we're getting a QA and then we're done.
I love
and
it.
Like, it just sets the tone. And then as the host, it gets you in a rhythm too. Because now you're like, okay, cool. I just started off. I broke the ice and now we're ready to rock.
100%.
You know? Yeah.
Can I give you one I think that you'll like as well?
Of course. Go ahead.
Which is that, and there's for sure truth to this, and especially when things get really competitive, this becomes really important, which is that in that opening, if you add in as well, like, hey, listen, if you're also already ready to invest in this deal, I'm going to drop the link right now, because it may be the case that by the end of this webinar, it'll be fully subscribed. And what I don't want you to do is spend the next hour watching this and only then realize that it's oversubscribed.
That's so
like,
good.
I'm just going to drop it and then just move on. And it just sets the expectation that at any time during this webinar, just click that link and you'll be good to go. But if the deal gets oversubscribed, you may be put on a wait list, and then it's up to like, who knows how long it'll take you to get it.
That's
So like
so good.
just a little drop and it'll help. But also it's like what you're saying, it's the state of mind that you're in as a business owner as the prize. It helps a lot to set expectations.
That's so good. Scarcity creates demand, and you just do that at the top of the call. I
Yeah.
love that. That's so good. Okay, so anyways, so what are a couple other tips? We talked about, setting the tone on these calls, and creating some sort of scarcity. What are a couple other tips someone can implement if they're about to do their first raise?
I mean, the podcast thing is amazing. You know what I'm saying? And it's like putting in work towards speaking and communicating effectively is rarely going to hurt you. You're probably never going to look back and go, I shouldn't have learned how to be a better communicator, right? And so for me, I say going on a podcast tour immediately is amazing. If you can get a lead magnet before you do that, it's probably a good idea, because if you go on a tour, you want to tell people where to go.
What's the call to action? Yeah.
Totally. Like your ebook, if it's a video that you did, if it's just a 10-minute thing, first name, last name, email address, phone number, and go on a podcast tour. Now, what you'll find is that it's hard to do. You got to book things. You got to have someone follow up. People cancel. Maybe you can't get on shows that you thought were cool and that you'd be able to get on. But like just putting in the reps matters. Now, I got to say one thing about reps, because I've helped a lot of people do this, but I'm going to tell about my own story.
Let's hear it.
Which is that, I don't know if you know a guy named Reed Goosens, good friend of mine.
Yeah, I know Reed.
All right.
I'm a big fan of Reed.
Me too.
From he's an Aussie, right?
That's right.
Yeah.
And so when I told a story about someone giving us $1 million discount, Reed was the guy that closed the deal the last time. So I got to give him a credit for that.
And he's got the podcast, like something about like making money in America or something like that.
Investing in the U.S.
There you go. Yeah,
so I don't really give him enough credit for this, but he was definitely the guy, like the specific guy that was like, you have to start a show. And it was probably 2014 when this happened. I was like, all right, I'm doing it. You're the man. Let's go. And so I was like, I remember I started my podcast and I'd done it for a couple months, and I was like, man, this is hard. Like, not easy to do a podcast. And I was talking to this kid, and he came up to me and was like, yeah, Hunter, like I heard that you started a podcast and I saw that you're having success with it. So I started a podcast too. And I was like, dude, it's hard, right? And he's like, I know, man. He goes, how many episodes do you do again? And I go, well, I do one every other week. So it's like twice a month that I'm doing it, but it's hard to get guests. And he goes, oh. I go, how many do you do? He goes, well, I do 7 a week.
Whoa.
And I'm like, what are
Joe
you talking?
Fairless.
No, but close, right? And he just started. Like, this guy had just started. So I'm like, well, how do you even do that? You have a full-time 50-hour-a-week job. And I was like, you start a podcast, you do a daily podcast, you got a 50-hour-a-week job and 3 kids? And he goes, well, that's the thing. He goes, I actually can only record on Saturdays and Sundays. I go, what are you talking about? He goes, well, I actually record 10 on Saturday and then around 7 on Sunday. And I'm like, okay, so this guy is recording 20 podcasts a week I'm doing a half a podcast a week. And I'm like, it's hard, right? And so you just need to, I'm saying this story because that's embarrassing, because I was literally thinking it was hard until you meet someone that's doing 100 times what you're doing, right? And you go, what level do I need to be on to actually be successful, right? And so that can happen sometimes in business where you think you're putting in work, you think, oh, Hunter told me to put in reps, and then you find out someone's doing 10, 20, 50, 100 times what you're doing. You go, is that even legal? The guy's working his ass off. Well, guess what? He doesn't work on Saturdays and Sundays anymore. He also doesn't work that 50-hour-a-week job, right? Because that 50-hour-a-week job was a 6-figure-a-year thing. Now he's doing a 7-figure-a-year thing fully on his own.
Because of the podcast stem that.
Because he put in the reps.
Oh, that's
you know
so
what I'm saying?
good.
And so that's the reality of what it means to just have that shift and go all in. Sometimes you have to get hit in the face with your own work ethic. And I needed that at the time. Now, we do about 5 podcasts a week and things are going well, but I got to give a shout out to Whitney, is the guy, Whitney Sewell, who has that show.
Dude, like you said, bro, like I think one of the reasons I've seen a lot of growth over the last 5 years is because I've always put myself in situations where the work has to get done. I've always put myself in situations where the hard way is the only way. And what I mean by that, it's like, okay, well, we're doing 3 podcasts a week. Okay, cool. Every Wednesday, I come in here, I rip 3 podcasts a week. These guests are coming in from out of town. There might be days where I wake up and I'm like, maybe I'm feeling under the weather. Maybe I'm tired. I didn't get good sleep. And I'm like, oh, maybe I don't feel like ripping 3 podcasts. But guess what? I don't have a choice not to. It's a non-negotiable for me, right? I committed to it. I'm doing it. To me, it's a sign of weakness if I see my competitors fall off, right? I see it all the time. A lot of my competition, I see them start posting social media content daily. I see them pumping the content. 2 months later, I'm like, where did these guys go? They all fell off. They couldn't hang. Same thing with the podcast. They're doing podcasts weekly or maybe twice a week, and then all of a sudden they don't put out an episode for 3 months. I'm like, dude, it's a sign of weakness, and I will never allow that to happen. I'm very competitive. And so I think because of that, I put myself in situations where the hard way is the only way. I put myself in situations where the content has to happen, the podcast has to happen. And that compounded over weeks, over months, over years is the difference between someone playing college basketball and becoming Kobe Bryant, becoming Michael Jordan. It's about the at-bats. It's about the reps. That's how this game works.
That's true. And Kobe was open about that, right? There's people that were on Kobe's level through high school that just watched him run circles. And he was like, oh, this is just because of the reps. And there's something else to that as an entrepreneur. I'm getting ready to do a YouTube video about this, which is that, I see entrepreneurs that struggle with perfectionism. It's the same concept, because they're kind of, if you ever look at like science and biology and especially virology, those scientists use fruit flies because their life cycle is like 50 days. And so you get a lot of iterations. You can see like, not literally evolution, but like, the strongest survive kind of vibe very, very quickly. You can see how different environments change fruit flies over massive generations in a short period of time. Does that make sense?
Yes.
Versus, like whales, for example, where they die every 100 years. If you were to study a whale, it'd take like, tons of human generations to get that information. If you're a perfectionist, your business is acting like a whale in iteration. You're not having enough repetitions in terms of market feedback to die and get a better version of yourself, whether it's your career, a strategy, something as silly as an ebook. Because I see these perfectionists, people run circles around them from people that just don't care to fail. Because if you wait a year to put out your first ebook, and you're listening to the show right now and you're like, all right, starting now, I'm going to write an ebook. If it takes you a year, someone that's stupid and just willing to do what I say is going to write an ebook in a week, and then they'll do a new one the next week. And by the end of the year, it'll be 52 versions of the book. And by the way, theirs will actually be way more perfect than yours, because perfection is impossible, but market feedback is constant. And if you make adjustments, you will win. So just speed is everything, but reps is part of that speed. You got to get the reps, you got to get the speed, take the market feedback and make adjustments.
That's so good. And you can apply that to almost any aspect of business or your personal life. You can apply it to social media posting. You can apply it to podcasting.
Yes.
It's like, just get started. And one of my favorite quotes is like, what separates those that are successful and those that are not often is the mindset. Those that are successful, the action takers out there, they typically have the mindset to where step 1, they have a target. And they're like, okay, I'm going to commit to this target. Step 2, they commit. Step 3, they figure out how. Where most people in life, they'll have a target or an idea. And then step 2, instead of committing, they go into a big planning phase and they wait for the plan to be perfect before they take step 3, which is to commit. And the problem is the plan's never going to be perfect. Conditions are never going to be perfect, and you can never account for anything. And so those that are perfectionists often never actually get to play the game. They stay on the sidelines their entire lives.
Yes, and
And
it
those that wait for
sucks,
perfect conditions never actually play the game.
especially in this industry.
Mm,
So the people that are best suited for the world of raising money are analytical people that actually care, that understand the gravity of the situation, that know that deals can go wrong. The problem, though, is that speed is so powerful that people that are incompetent will run circles around you and get the money and blow it into the ground, light the money on fire, do bad deals. So like if you're a procrastination, AKA perfectionist, AKA architect, engineer, CPA, lawyer type, brainiac type of person, you need to rise to the occasion to beat these bombastic idiots that aren't weighed down by analysis paralysis. In the end, you're the one, gifted enough to see how deals can go wrong, which will make you a great underwriter. But if you can't get out there and make some mistakes, you won't be able to get the money and someone else will.
yeah, I love that. I love that. I got one more question for you regarding the capital raising technique on the back end. You're getting a tail end of these raises and they start to stall out. For someone that's listening to this right now and they're like, hey, I've expanded all my resources and I need to get this one last chunk of capital in. What are a couple techniques that you like to utilize?
Woof, man, it's tough, right? I just did this meme on my Instagram where you may have seen it, where it's like the Titanic thing, and it's like Rose and what's the guy's name from Titanic, but whatever, Leo.
Yep,
And he kisses
Leonardo.
her. Yeah, and he's
Yeah.
like, he kisses her hand and he's like, just did my first capital raise. And she's like, oh, amazing, how'd it go? He goes, yeah, we raised enough to close, just raising the rest of the capital expenditure after the fact. Because after you close the deal, people always have to raise more money. But anyone knows that like once the deal closes or once that initial pop happens, it's like you are scratching and crawling.
Yeah.
And then of course it cuts to her being like, it's been 84 years. Anyway.
Oh, that's pretty good.
Yeah.
And real quick on that subject, because I've closed deals before in the past to where we had enough to close, but we still had to continue raising post. And I'll say this for anyone listening right now, it's a lot harder to raise post-close than before because post-close there's a sense of urgency. Hey, Mr. Investor, we're closing on this deal 10 days from now. Funds are due 3 days from now. Are you in or out? And it's like sense of urgency for them to like make a decision. Post-close, there's no sense of urgency other than, hey, we got a couple spots left, or hey, we were down the last couple $100,000, whatever it might be. But it's like, okay, you already closed on a deal. You're continuing to raise post-close. Clearly, there wasn't enough demand, right? And so scarcity creates demand. And so there's no scarcity. There wasn't demand. And now it becomes much, much harder to raise the capital. And so that's something to note. If you're going to deal, I would try to always raise all the money beforehand if you can.
100%. So let's get down to the nitty gritty though, because this is something I've dealt with, right? Especially when interest rates were changing, it became people sketched out, or people would say they're going to invest 200 grand and pull it all out at the last minute. Like this stuff would happen. And so what I would say is first, the best way to do this though, is to just fill up your pipeline with potential investors, constantly be raising money, constantly be getting soft commitments, constantly be getting indications of interest, whatever you can do to, even if you don't have a deal, just talk to investors, talk about the amount of money they're interested in investing, give them a range or ask them for a range so that you should never not be talking to investors and getting ranges of interest of investment.
Yeah, I love the range.
Yes.
For me, I always ask from a min-max perspective, should this deal or should this opportunity be a fit for us to work together? How much are you interested in investing? And they always say, hey, 100 to 250, something like that. And then okay, they're good for something in that range. I love that question. And it's a very nonchalant way of asking how much money do you have?
Totally. And the other thing is it's like they may be like in their mind going through this exercise without really thinking the money's going to leave their account and go to yours. So if they say like, whoa, I'm actually not interested in investing something like this, like now versus assuming they're going to be in and you start to count them as an investor in your mind or, from an actual standpoint. This way it's like, hey, listen, this isn't just for like entertainment purposes only. Like we're going to have a deal soon and I'd like to know so I can reserve your spot or whatever. So, but once you do enough of that, those undersubscribed deals will become less and less. But let's say you don't do enough of that. And let's say you get in one of those spots, I think texting is wildly underutilized. So like personal texting, or if you've got a larger audience, using some sort of go high level or like sales messenger or something like that to like get a real response. text messages have around 30 times the open rate of
Email,
emails,
yeah.
and responses, it's like 100 times the response rate. So anytime we put out a deal, people are getting texted. If we have to go through this process again, I'm sending a follow-up thing, which is usually uncovering or revealing that there's a really compelling part of this deal that I hadn't talked about yet, right? So it's like, I want to keep things in my back pocket. So as the raise is coming out, I can reveal that there's more justifiable touch points. So I'm not just spamming you saying, same deal, here's all the information. Same deal, here's all the information. I'll be like, hey, new, amazing. We got an appraisal that's $500,000 more than our purchase price. Good news, built-in equity, right? So in the event that the raise doesn't go well, I can start pulling these out at the right time.
Yeah.
So like that would be
Interesting.
another one. And that's like, there's a broader
Good
message
news.
there.
We ended up getting a little bit better interest rate than we thought we would.
Absolutely.
Yeah. Okay.
Absolutely. And we didn't change anything else. All the fees are still the same. That just means the returns are going to be higher.
I like that.
Another thing though, is that using that as a mindset thing, if you blast all the information out to your investors, there's no justifiable reason for you to hit them up again, except for if you're coming up short. But if you drip it out, now there's like 5, 6, 7, 8, 9 justifiable touch points. And so that will be the kind of thing that will really get people re-engaged. And then I will also do, if things get really gnarly, then we're doing, double call, personal phone call, double call, personal text. And then maybe
when you say double call, what do you mean?
Calling someone, they don't answer, calling them again, they don't answer, then shooting them a text, like that kind of stuff. It's more of like a sales type. You're cranking up the intensity. Like you got to get the deal closed, like stuff like that. Or another version of that would be call once, they don't answer, call another time, they don't answer, wait 3 hours, call again, they don't answer, call
then
again,
text.
and then text. Cause it's like, once they know who it is, they're maybe less inclined to answer. But I don't want to use any of this stuff, but if you start coming up short and you've got $500,000 of earnest money that's about to go hard, you want to know if the money's coming through or not. So those are a couple of things I do.
Yeah. I really like that. And one thing I didn't realize, and we started utilizing this with our fund, I didn't know this my first few years of raising private capital, but I learned this from Mikey Taylor. And Mikey told me about this, and I ran it by the SEC attorney, and they're like, yeah, we can essentially do this for you. It's not a big deal. It's relatively easy, but you can always start an offering as a 506B, which allows you to bring in up to 35 non-accredited investors. However, you cannot go and market or solicit the offering on social media or talk about it on a podcast. But you can go and get those 35 non-accrediteds, friends, family, etc. And then once you get all the non-accrediteds in that you think are going to participate, you can go to your SEC counsel and switch it from a 506B to a 506C, which doesn't allow you to bring in any more non-accrediteds. However, you can go market, solicit, you can go host an investor webinar, and go blast your email list, go blast it on social media, and get a bunch of people to come in to finish off that raise. And so it kind of gives you the best of both worlds. It works for a single asset syndication, also works for a fund. And so it's something that we did with our fund. We got into 35 non-accrediteds, and then we've switched it to a 506C, and it's been great. I love it. And now I can openly talk about the fund.
Totally.
Yeah.
And for anyone listening, you probably won't get this massive pop switching to a C, but from my perspective, it's well worth it. Like I think the C allows you to get in the habit of doing what I think you should be doing, which is talking about what you do on the internet. And the more you can do that, the better. And so, if you're just getting started raising money from non-accredited investors, I've got nothing against that. That's exactly what I did. But like you said, there's a reason that you started raising more and more from only accredited investors. It's a more scalable way to do the business. They're less friction. It's less of their net worth. So they're not going to be destroyed if something were to go wrong. And so the likelihood of litigation is probably less. So you can kind of do the math. But look, if there's one thing you take away from this, it's that this mechanism right here, this is a nice microphone, but let's say it's $100 microphone. You go buy that, hit up someone that you always wanted to ask for advice, and click record on Zoom, and then put it on YouTube. Just take that key takeaway, and the combination of that and not being afraid to fail. Like if that person says, no, it's all Gucci, keep going. That's what happened to me. That's for sure what happened to you. And eventually you'll start to get that little fire starts to burn. And then eventually all those people that said you would never do it are asking, hey, how's that little YouTube thing going? All of them are like, I always knew he'd make it. And that's the progression of a normal entrepreneur.
It is the progression. And one thing I'll say this about raising capital is, and anyone listening to this, you will, as you get more reps in, more at-bats in at raising capital and having these conversations with potential investors, you will learn the little nuances of what makes an investor that's going to move forward versus an investor that's just going to waste your time. So I like to say this, our highest check investors that write the bigger checks, It's a very short conversation. And it's like, hey, what's the wiring instructions? Let's go. We'll count us in. And then it's like the investors that don't end up investing, it's the maybes that suck all the time. And so I always try to get to a yes or no as quickly as possible. So yes, great, we get capital. No, we get time. The maybes that ask 100 questions, that want to, jump on multiple conversations. They want to ask you about the debt. They want to go drive by the properties. What are the property addresses? They want to see all this stuff. Those investors never move forward. And it's typically those investors that suck all the time. And so I know right away now, and I get an investor, hey, I always ask, hey, have you ever participated in an offering before? No. But I got all this money and I have all these questions, and they just want to ask question after question after question. Our investors that invest with us, they don't ask millions of questions like that. They don't want to drive past they're like, we trust you. You guys are the operators. We just want to make money and give you our money and give us a return, and that's it. We trust you that these deals are going to go good, and that's it. And so these investors that jump in millions of questions, I'm like, I know right away. And also the ones that start flexing big numbers right off the bat. Oh, I got this money and that money, da-da-da-da-da. I'm like, those guys and gals rarely move forward. And so I know right away it's a red flag on my end. As much as they're doing due diligence on us, we're doing due diligence on them.
Yeah.
We're not going to be a fit to work together. Let me refer you to a couple other operators that might be a better fit for you. And that's it. And honestly, people don't like being told no, but I'll say no to investors now.
Yeah, I like that. And look, it's an illiquid investment where you're running the show. You cannot sell their interest in the deal when you want to or they want to. You're committed together. And so anytime you open up an LLC together, it's like getting into a marriage together, right? So we're stuck together, usually for years, in my industry at least. And so you want to vet people. But, take it back to the conversation. It's like the best way to vet someone is to create content that attracts your people to them. So like the more you lean into who you are, the less you're going to have sticky investors that are going to waste your time. Because if you're talking about how you don't like to work with those people, they're going to be like, I'm not that kind of person. You're like, great to hear.
Yeah, that's so good. That's so good. Well, dude, I appreciate you coming on, Hunter. I've always been a big fan of everything you're doing, man. It's great to connect in person and keep crushing. Where can the folks get in touch with you? But also, they want to learn how to raise private capital, jump in your community. How can they learn more about it?
So we're doing an event that's going to be in a couple of months. If you go to raisefest.com, it's going to be in Phoenix. There's going to be 1,000 people there. We did one last year. Pace Morby will be there. Cody Sperber will be there. I probably shouldn't even announce all these. Anyway, I'm going to keep the rest of the names.
Yeah. What are the dates on it?
But February 20th to the 22nd. Go to raisefest.com. Check it out. My company is raisingcapital.com. And if you're a passive investor, it's ASYM Capital, which is our private equity company, ASYMcapital.com. But dude, RaiseFest is awesome. I think we spent, a lot of money on just like sound. So it's like a rave basically where everyone learns how to raise millions of dollars and make it rain. So check it out.
That sounds fun. And I'm a big fan of Pace. Pace has been on this podcast 3 times now. I love Pace.
Yeah.
Anyways, hey, my man, appreciate you. He's Hunter Thompson. I'm Rich Summers. Listeners, thanks for tuning in. We'll see you in the next one. Peace.